Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to do what we usually do and give you the updated version of the portfolio. Not the updated version, but an update on the portfolio. We're going to talk about the boring stuff, this long dragged out series that's not a Netflix original in the economy, and the boring good old stuff that everyone is expecting, because by the time you're watching this video, you probably heard about the interest rate probably changed. Bank of Canada probably raised it. TIF doing his job, So if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. So as you can see today, the day before you watch this video, on a Tuesday, but you're going to be seeing this on a Wednesday, portfolio is closing out at $13,347 and 28 cents. We're down. We are down for the day, down $164.38, down 1.22%. For the week, down $468.96. For the 1 month, down $402.82, down 2.93%. For the 3 months, down $537.23, down 3.87%. For the 1 year, we are down $362.38, down 2.64%. And for the all, we're up, but down. We're up $841.31, up 6.73%. New month, new beginnings. Great way to start the first trading day of the month. Not the first trading day, because the first trading day would have been the first, which was Thursday. Continuing the downward spiral of equities. We currently have $48.87 in the cash account and $100 that gets deposited every single week to build a dividend portfolio right in front of your eyes. Now, a lot of people are probably thinking, what the heck are you building? You just keep throwing money into a hole, because that's what it feels like. But yeah. That's what we're doing. We're going to continue to purchase positions, because you've heard it before, cliche because it's true. Buy the dip. We've continued to do what that cliche is and buy the dip. You don't hear it as much as often anymore, because I think eventually it just sunk into everyone's brain and they just automatically do it unless you ran out of funds. Now, that happens, the first drop, you dumped a bunch of funds, and the next drop, you dump some more funds. And then the third drop, you're just like, I'm out of funds. I can't do it anymore. And it just goes into this endless pit. But it is what it is. So we'll just continue doing what we're doing. Consistency is key. We like consistency. We like consistent dividends. We like consistent dividend growth year over year. We like consistent free cash flow. If you don't know what those things are, I suggest you go do some studying and then come back. Because if you're a new viewer, then it makes sense that you don't know what those are. But we're not going to talk about that. The portfolio is doing its thing. I'm sure we're used to it by now when it comes to this portfolio on consistently growing $100 every single week. But let's talk about what's happening today. When you watch this video today, Bank of Canada is meeting. Tiff, the guy, the man, Macklem, he's kind of like your Jerome Powell. He just doesn't have the celebrity status that Jerome has down in the US. I think everyone forgot about Tiff. Everyone's like, oh, Jerome Powell, the US guy. Funny that a lot of Canadians know who Jerome Powell is, but don't know who Tiff Macklem is. Now, not McClam, but Macklem. He's the head guy for Bank of Canada. And we either see a 50 basis points raise or 75 basis points raise by, what a lot of people are estimating. Those are your economists and strategists. But who knows? Maybe he might do another jump scare and do you 100 basis points. Who knows? We're unpredictable apparently in Canada compared to the US, where they're just like, yeah, we're gonna raise it 50 basis points. And what did they do? Raise it 50 basis points. Over here, nah, different story. We like to be surprised, but not surprising at all. So as you're watching this video, you'll probably see, and my guess is they'll probably raise it 75 basis points. To try to break the back of inflation. But what does that actually mean? Because, we've heard this story over and over and over again about how raising the bank or raising the prime rate in Canada will break the back of inflation. Now, I'm sure a lot of people know what that is, but what are the repercussions of that? Well, let's talk about a generation, maybe a couple generations now, that have been struggling for homing. And this is not getting political. This is not financial advice. I'm just giving you the stats. It's been tough for those in that millennial generation and every generation typically after that when it comes to home ownership in Canada. Now, just because we hear that it's been tough for millennials or any other generation to purchase a home, I don't think that's technically true in most cases around the world. I think it's very concentrated in the landmass we're stuck in. I'm sure on other parts of the world they're fine. It just seems that we make a big stink about it. Now, if home ownership is not in the cards for you, where you don't want to have a home or own a home, but you're okay with renting, that's totally cool. This video is probably not for you, but it's always good to know the facts. So every time, just so people get an idea of what interest rates do, even on a 25 basis points increase, it takes out 50,000 potential home buyers out of the market to have home ownership ever. And so when we were back down, I think, what was it, like we were at like a percent, was it 1.25 maybe? Or 1.3, and then we raised it up 25 basis points and then 50 basis points. Every quarter of a basis points, every 25 basis points knocks out 50,000 potential home buyers in the market and forces them to be renters. Excuse me. And that's not fun for people who have dreamed of owning a home, who are working hard to own a home. And it does suck, yes, 100%. But let this be a sign that there are other ways of having home ownership, whether it means partnering up with a sibling to purchase a home, partnering up with friends to get into the real estate industry, figuring out a strategy to get to that point, because it is feasible. Don't get me wrong. It's not like those TikToks that you see that you need 3% down and you can buy a home. It doesn't work that way in Canada. You need a minimum of 5% in Canada, and you cannot get a mortgage for free unless you are some advanced hard money lender kind of real estate investor. Now, I have no clue how to do that, so I'm just not going to talk about it. But saving at least the 5% down can be very difficult for some people. I think for the most part, we're hearing concentrated pockets of these issues, mostly in highly populated areas. So I'm talking like BC area, I'm talking Ontario, and a little bit of Quebec, and that's where we hear most of those things, because those are where the highly populated areas in Canada are. Remember, there's this huge landmass that we live in Canada, and the majority of news comes out of those three areas. You typically don't hear about the other provinces, other than political stuff and oil and gas. But when it comes to housing, I think it is possible to save 5% down. If you make anywhere from that 60 to 100K, you're good. You have the ability to purchase your first home. Now, it might not be your dream home, but that's why they have the term starter home. Now, BC is probably a bit different, because you probably need a bigger down when it comes to the housing prices there, and especially in Ontario or Toronto area. But that's what rising interest rates does to the market. It slows things down almost completely, not completely, but a fair bit amount, where inflation does come down, but it's still not possible for your Canadians who have worked hard to purchase their first home without having a substantial money down. And every time they get to that like checkpoint, it seems like the goalpost gets moved again. And so, not complaining or anything, but you got to find creative ways, not creative ways, but find ways that can get your foot into the door in real estate and home ownership. It might take longer than usual, but than what's average, but we're in a different kind of world right now. We're in a different kind of economy. And so even partnering up with a friend to get into home ownership, partnering up with a spouse and things like that, but you can do it. You just got to figure out where your finances are, what you need to do to save, and how to deploy that ASAP, instead of maybe maybe delaying some purchases, maybe delaying that new car, maybe delaying, the Pokemon cards, maybe delaying the new computer systems. Things like that do play a part in whether or not you can save money for like a down payment to have your home ownership. And so hopefully that helps, guys. But if you're watching this video, I think Bank of Canada, I think good old TIF is going to raise the interest rates by 75 basis points, and every 25 basis points it knocks out 25. Is it 20? Did I say 25 or 50? Anywhere from 25 to 50,000 home buyers. And I think we're past that part where no one can afford a home unless you're selling your home in BC or you're selling your home in Ontario and moving out inward to Saskatchewan or Alberta or Manitoba, where housing is affordable, or way far out east, out to the island there, boy. And you need to buy a house out there, boy. And so other than that, guys, have a great week. We'll see you in the next one. This video really wasn't anything other than talking about an interest rate and what it does to the housing market. I know it's a dividend channel, but hey, let's talk about something new. So don't forget to leave a like and subscribe, and we'll definitely see you guys in the next one. Bye.